The current stock market setup is unlike anything that new investors have experienced since 2020. Indecisive index movements, abrupt stock rallies, and even sharper reversals and relatively moderate returns have been some of the defining features of the equity market in recent months. This has left many investors wondering whether this is what we have signed up for. The question here is, will this uneasy trend continue, or is the market rally that many of us are so used to round the corner? It's Thursday, November 27th. I'm Nishanth Vasudevan, Markets Editor at the Economic Times and your host for today. And you're listening to the Morning Brief. To help us make sense of what's happening in the market today, we have one of India's most seasoned fund managers with us. Prashant Jain, co-founder and CIO at 3P Investment Managers. Many of us know Prashant from his long stint at HDFC Mutual Fund as its CIO and for his bold contrarian calls. Let's hear from him on what's happening in the market these days and what's in store for investors. Welcome to the Morning Brief, Prashant.
Pleasure, Nishant, absolutely.
So, to start with, Prashant, you've seen multiple stock market cycles from the Harshad Mehta era, the dot-com boom and the bust, the 2003 to 7 bull rally, and now this AI-led markets. Do you see any familiar patterns playing out today that probably remind you of some of the turning points in the past?
Nishant, I would say mostly no, some yes. See, 1992, 2000, 2007 were three broadly periods of excessive valuations in the markets. Now, if you look at the market valuations today, they are not excessive. And in 92, the index markets went to almost 40 times multiples, Today we are trading around 20 odd times 1 year forward. So I don't think the markets are in excessive zone. But yes, there are few pockets in the markets which are quite expensive. I would say maybe the small and mid caps, maybe some of the popular theme driven stocks. But bulk of the markets, I would say, which are basically the large companies, appear to be sensibly valued. Yes.
Yeah, right. Prashant, you have gone against the consensus several times, even at some crucial junctures. You also have the reputation of holding on to some of the most hated investment themes at that time, even when the tide was against you. Now, today, if I may ask, is there any non-consensus view that you are holding on to that many in the market would disagree with?
So this is a market where the dispersion in valuations is extremely low. You get deeply out of favor or deeply hated sectors, typically when dispersion in valuations is extremely high. Today, which is missing. So I would say there are no big time non-consensus kind of calls, but still I would prefer large caps over small mid caps. Most people in the market feel small mid caps will continue to outperform the large caps. And I would also be cautious in some of the themes that have become quite popular over last few years.
Yeah, that's interesting. So would you like to elaborate on some of these themes that you are cautious on?
I feel the consumer companies, the consumption theme has been one of the prominent popular themes post-COVID especially, because consumption held up then and capital spending or lending related businesses had suffered. It has long headroom for growth, but yet I feel that whether it is consumer staples, white goods, brown goods, many retailing companies, while they should continue to grow, I think the valuations leave not enough room for attractive returns in that space. The second theme, I think, which became extremely popular was the manufacturing stroke, capital goods stroke, even defense, I would say. I think these are again good businesses, but probably they were meaningfully overvalued at least some time back. One key difference between 2003 to 2008 capex cycle, that way back then India was facing lots of shortages in core industries like power, intercity roads, ports, airports, telecom. Today, I don't think any of the core industries face meaningful shortages. The third theme which we are seeing play out in the markets is that the small and mid companies have generated very high returns post COVID. The key reason to my mind why this space has created higher returns is that, let's say, if large caps fell 30% from 100 to 70 pre COVID, the small mid caps fell maybe 60-70%. They fell from 100 to 30 or 40. In the normalization phase, indices should have doubled over 5-6 years. But instead, in large caps, they've gone from 70 to 200, which is 3x return. And in small mid caps, they've gone from, let's say, 30 or 40 to 200, which is 5 to 7x return. So the higher returns of small mid caps in last 5 years are largely a result of the low base that these stocks had fallen to post COVID. Also, what has happened, pre COVID, there were 3 crore demat accounts. Today, there are 20 crore demat accounts. So, the 17 crore investors, 80% of the investors do not have an experience of markets pre COVID. And what they have experienced is the much higher returns in small mid caps. And that's why these stocks have probably overshot the fair valuations by a wide margin. So I would be again cautious in that space. Yeah.
Prashant, one major trend in the market in 2025 that we have seen is, the IPOs. We have seen a flood of IPOs, and it is known that, that the domestic investor liquidity has been an enabler. But from a point of view of the quality of IPOs that have hit the market in recent times, what are your thoughts? Do you think many of them are questionable investments?
So Nishant, I think whenever there is a lot of money flowing into the markets, whenever pockets of markets are richly valued, you will find a sharp increase in supply of stock, especially in those pockets. This happened in 92, it happened in 2000, it happened around 2007. We are seeing something similar like internet driven businesses, new platform oriented businesses, RE, EVs, manufacturing, small and mid caps, variety of companies. These are seeing huge supply. I think this is a very personal opinion. I think the long term outcomes will be quite disappointing to most of these cases. I think still this is great for the country. This is great for our economy because if you give money to 100 entrepreneurs, hopefully 5 or 10 of them will make very good use of that capital. So I would say investors should be cautious where they want to invest their money, but either whichever way the outcomes are of these IPOs, I think India and its economy should be a winner.
But now, sir, there's a related question, which is, many of these new age businesses tapping the IPO market these days are still loss making, but many of them are quite aggressively valued. Now, we have heard that traditional investors who have seen earlier cycles often struggle to understand how to value these businesses. In your experience, have you faced such a dilemma in your investment decisions on how to value these businesses?
No, Nishant, I would not completely agree with that viewpoint. See, the key is not current profitability. The key is what in your assessment is the potential profitability 3, 5, 10 years down the line. And no one can come up with a accurate estimate of these profits. But I think directionally it is possible to make some assessment of profitability because we know Over time, the customer acquisition costs should head lower. We know the market structure, and in these businesses, typically one dominant player can be bulk of the profit pool in that space. And some of these structures also or platforms also give you huge decent pricing power. Yet I would say that while lack of current profits is not the deal breaker, but in some cases the multiples or the asking price is disproportionately large compared to the total addressable market opportunity and therefore of the potential profits. So, in many of these cases, we are not comfortable with the valuations. But as investors, we need to be cautious that whether investments will do well or not. So, valuations become extremely important in that case.
And do you think that the constant supply of papers through IPOs that we are seeing right now, is it somewhere weighing down the secondary market?
Yes, of course, without doubt. But I don't think it is particularly negative because when broadly 4 to 5 lakh crores of money is flowing into equities as an asset class each year, if you do not have a large supply, it could lead to unsustainably high valuations in the secondary markets. It may prepone front load your returns, but it would not be sustainable, it would not be good in the long term. So, as I said, I am happy that this supply is there. It is good for the stability of capital markets. It is good for the economy. It is good for the entrepreneurs. But individual investors have to be cautious about where they want to participate in.
Now, Prashant, in the past year or so, there's been a lot of debate on spreading your risk beyond equities. But for anybody who's entering the market at the moment, what is your advice to them?
So, Nishad, I think if you are moving beyond equities for reasons of diversification, I think it is perfectly justifiable. How much one invests in equities would be a function of one's tolerance for volatility, ability to hold on. I think equities are volatile, but probably they are not as risky. And let me try and differentiate the two. So, if you look at returns over 5-10 year periods of holding Indian equities, in I would say almost all of these cases, you have made money. But year to year returns have been volatile. If you hold equities, good quality companies, reasonably valued for reasonably long periods of time in a diversified portfolio, I think there is a very good chance that not only will you not lose your principal, but you will generate returns meaningfully above inflation. Now, what kind of returns can be generated? I think the answer to my mind is very clear. In large cap companies, I think Indian markets should compound around 11-12% over the next many years. However, I would be cautious in the small and mid cap spaces.
Right. Now, one concern which everybody is talking about these days is the AI investments. Many people think that there is some sort of a bubble in AI. What are your thoughts there? Is it something similar to what you've seen in the past?
So, Nishant, I think in very broad terms, it appears to be similar. I am, however, not sure whether the US markets will go into a deep correction or not. I mean, I am neither an expert nor do I devote time. So, how do I assess the impact of this on the Indian markets? So, let us take two scenarios. One, US markets don't correct massively. In that case, clearly there is little concern for Indian markets from that point of view. The second is, let us say the US markets go into a sharp fall. So I think if that happens, it is reasonable to expect some near term, short term impact on Indian markets. But I would take that as an opportunity to invest in Indian markets. And why do I say that? See, few things are important here. One, the Indian economy is unlikely to be materially impacted. India is mainly a local consumption driven economy. Our current account deficit is extremely low, which means your savings and investments are roughly becoming equal. So if dollars stop flowing into India, it will not have a meaningful impact on India's economy. Now the second issue of this is, what is the impact on capital markets directly? I think we all know and we understand, it has been written about a lot. The flow of local capital to equities is not just large, but it is also very granular and therefore very sustainable. We have seen time and again the impact of foreign selling on Indian markets is not just shallow, but it is very short lived. So I would expect, even if US markets were to correct, even if foreigners were to sell, the correction this time around should be a lot shallower and a lot shorter. What typically is happening in India is, whenever foreigners are selling, markets come off, let's say 5% or 10%. The potential or the pipeline issues get deferred by 2 weeks, say 4 weeks, 1 2 months, and the flow of money to the markets gets deployed largely in secondary markets. So the supply of new issue is self-balancing in a way, and that is why we are seeing the volatility in secondary markets has come down very sharply.
Right, sir. So, before we wind up this discussion, our listeners would like to hear from you whether this era of extraordinary returns that we have seen from equities so far, is that over? Should investors brace for a period of moderate returns?
So Nishant, I think Indian markets have delivered very healthy returns in the past, but I think we need to be mindful that if inflation in the country over last 2 decades has fallen from 9, 10, 11% to 4%, it means far sharply lower nominal growth of the economy. It means sharply lower growth in company top lines. But your real returns or the increase in purchasing power till 2000 were about 5% a year, because that was the real growth of the economy. And now we expect the purchasing power from equities to grow around 6 to 7% a year. So in a way, equities are creating wealth faster and not slower. But yes, in rupee terms, the returns are likely to be lower. I think a second issue here is that the best returns in the markets are typically made on investments made in the worst of times. And the biggest mistakes are made in the best of times. And as I said, almost 70-80% of direct investors have joined the markets after COVID. And it would be wrong, in my opinion, for them to extrapolate those high returns which were there of a low base. But I think Indian markets should continue to compound around 11-12%, and they should increase our purchasing power by 6-7% a year, which to my mind is extremely healthy.
With that, we end today's episode. Some of the key takeaways of today's chat are: investing in some pockets of the market, such as mid caps, small caps, defense and manufacturing, and consumption, could be a tricky proposition. Another area that Prashant is wary of is the flood of IPOs aligned with some of the popular investment themes. That said, he believes that there is still meaningful scope to make money in large caps over the next 3 years. Thank you once again, Prashant, for joining us and sharing your valuable insights. And a big thank you to all our listeners. This episode was produced by Vinay Joshi and Anirban Chaudhary and sound designed by Amrit Reggie. The Morning Brief drops every Tuesday, Thursday and Friday on your preferred audio platform. So be sure to tune in.